Well, good morning, everybody, and welcome to our latest investment briefing. Thanks very much for joining me. For those of you who don't know me, my name is Mike Deverill, and I'm partner and investment manager at Equilibrium. Now, obviously, because of the government's Plan B COVID restrictions, we weren't able to do this presentation face-to-face. Happily, they are being lifted, those restrictions. So next time we should be able to go back to doing a face-to-face presentation, but we'll also offer an online version for those of you who aren't able to join us. But no matter, we're still going to have a similar agenda to what we normally look at. As usual, we'll look back about what's been happening in the economy over the last quarter or so, and what we think the outlook for that economy is. We'll look at how that is affecting market trends and how that economic outlook is affecting all the various asset classes we might want to invest in. And then, of course, we'll look at how we've positioned portfolios to adapt to those changing market conditions. And we'll look at what effect that has all had on returns. And as usual, we want to hear from you. So if you want to ask a question at any time in the presentation, please hit the Q&A button on your screens. And then at the end, I'll be joined by my colleague, Ben Rogers, and he'll help me to go through and answer all of those questions. So the presentation itself should take about 45 minutes, and then we've got maybe 10, 15 minutes for questions, whatever we need. Now, officially, the presentation is up to the end of the last quarter, up to the end of 2021. And we like to stick to kind of quite a rigid timetable around these things, just to make sure we're reporting in line with the valuations that we send to you. But clearly, lots has been going on since the start of this year. So where appropriate, I bring things more up to date than that. And actually, I want to start with just looking what's going on in the markets, actually more in the last couple of weeks, or last week really, by just looking at returns so far this year. Actually, this is looking at returns of just these three market indices over the last month, up to the 24th of January, so up to close on Monday. And I'll particularly draw your attention to the red line, which is the S&P 500. Over that period, the S&P is down 7% over there. The NASDAQ index, which is more technology-based stocks, is down 11% over that 1 month period. Even if we look at the FTSE 100, which actually started 2022 really, really well, is actually down 1% over that period. Up to close on Monday, it's actually rallied a bit today and yesterday, so that's good. So there's lots going on at the moment, lots of volatility, but even these kind of, if you like, headline figures hides a lot of that volatility. If you look at this last kind of day, this last valuation point here, you can see the red line kind of goes up. Well, that's looking from one day's close to the next day's close, but intraday, we saw a huge amount of volatility on Monday. This looks at your typical intraday moves, your daily range for the US stock market. Now on Monday, the S&P 500 fell 4%. But then during the course of the day, it made it all back and actually closed the day slightly up, which is pretty astonishing. There's not many times it's fallen 4% and then ended up. And in terms of actual intraday movements, that is the biggest intraday move we've seen since March 2020 in the depths of the pandemic. So there's lots of volatility going on, and some of it's kind of going on under the surface, and that's affecting, of course, returns at the moment. Now, I put this presentation together before most of this volatility, but I think it actually is all still really relevant because actually explains why I think markets are so volatile and what's driving returns at the moment. So, it's an interesting time. What is on people's minds, of course, at the moment is what's happening in the economy. As I mentioned earlier, we had Plan B regulations in this country because of the Omicron variant. Now, happily, it looks like that variant is not as serious as perhaps we might have first feared. And so the government feels able to drop some of those restrictions. So from an economic point of view, that's really positive. We should hopefully therefore see economies continue to recover this year. It is also a bit of a warning shot, I think, by the way, because of course we do know that at any time something like that can come out of the woodwork. But in terms of the economy, there's one thing that everybody's focusing on and one thing that's driving all the returns in the market right now, and that is inflation. This is my favorite GIF to illustrate inflation. If you've seen Charlie and the Chocolate Factory, you'll know that this is Violet Beauregarde. And if you've ever read the book or seen the film, you'll know that when she inflated, it didn't really end well. And inflation is a problem, and it's a problem pretty much wherever you are in the world. It's a global problem, unless you're in Japan. Now, Japanese inflation, still very low. It is at least out of deflation for a change. So that's, positive for them. But anywhere else you look, you're seeing high levels of inflation. Here in the UK, inflation, CPI inflation is 5.4%. Germany is pretty similar. Even France is well above 2%, and that's pretty high for them. In the US, inflation is at 7%. So we looked at inflation in quite a bit of detail in the last presentation. But I want to recap on that today and bring some of that up to date. So what is driving that inflation? This is looking at the contributions to UK inflation. As I say, the total is 5.4%. There are two bars that we can see on here. This is looking at how much each sector of the economy contributed to that overall number. There are two bars on here that really are driving a lot of that inflation. The first one, housing, water, electricity, gas, and other. So basically household bills contributed 1% of that total 5.4. So I'll come back to that in a minute. But the biggest area of inflation is transport, which contributed 1.6%, sorry. So if you just look at transport and housing bills alone, that's 2.6% inflation, even if everything else was flat. And lots of strange things going on in transport. But the good news, I think, with a lot of those things is I do think they are temporary. So what are we seeing in transport? What's driving transport inflation? One of them is used cars. Used cars are up 28% over the last year. And what's driving that is the sort of supply chain issues we've been talking about before. Manufacturers of new cars have found it difficult to get the supplies. So there's been less supply of new cars. And of course, then people buy used cars instead. But the biggest driver of transport inflation is actually the oil price. So over the last year, in sterling terms, which is what's important for UK inflation, Brent crude oil is up 57%. So that's a really big gain in the oil price. That then feeds into the prices we pay at the petrol pump, of course. And I think it's important when we're talking about inflation that we always remember what we're looking at with inflation is always 1 year's prices, the change in prices from 1 year to the next. So over the last year, Brent crude oil is up 57%, and therefore we get a huge amount of transport level inflation compared to this time last year. But if transport is going to contribute the same amount to inflation over the next 12 months, then Brent crude has got to go up 57% again. That, I never make any guarantees with anything, as you know, but that, to my mind, is almost certainly not going to happen. So, and I think looking at 1 year figures can sometimes be distorting. Because if we look at the oil price over the last 5 years, and actually let's just draw a line across where we are today, we're only back really to levels that we've seen previously, back in early 2020 and back in mid-2018. The oil price is recovering from that big sell-off we saw in 2020. The oil price fell about 80% in the pandemic, and it's just getting back to normal. So yes, it may continue to go up, but it's certainly not going to go up. I would be, almost put, I put plenty of money on it, that it's not going to go up at the same pace over the next 12 months. So I do think transport level inflation is one that we can pretty much put in the temporary camp. Energy prices, however, are a bit more of a concern. Now, I don't know if you saw these sorts of headlines that, you know, OVO Energy thought they would send a helpful blog out to customers with loads of tips on how that they can stay warm and keep their bills down in winter. And they suggested you might want to cuddle your pets, which I don't think was particularly helpful. I don't know about you. These are my pets, or rather my kids' pets. These gerbils don't give off a great deal of heat, and they don't really like being cuddled either. So, you know, that wasn't really a very helpful set of suggestions. But we do have an issue with energy prices at the moment. Now, energy, of course, is subject to a price cap, and that was last reviewed in October, and the prices went up substantially, which is why we're seeing inflation now. But it's going to be reviewed again in March, and the energy bills, energy prices are likely to go up even more again from April. And the reason they're going to go up again is, of course, that the underlying cost of things like gas and electricity has gone up. This chart shows what's happened to the global natural gas prices over the last year, up getting close to 40%. So when we next get that price cap review, you know, some of that is still got to feed through into prices. So I think, you know, prices are going to go up again. We should be perhaps slightly careful about some of the more apocalyptic headlines about it, though. So whilst I'm sure they're going to go up, we do also remember that from April onwards, we're hopefully going into some slightly warmer weather. So we'll be using a bit less energy, and that should have therefore less of an impact than if it was happening in the winter. I also think it's very likely the government's going to take some action and step in. I mean, God knows they could do with some good news at the moment to distract from some of the other things that are going on. So whether they will do a VAT cut, which lots of people have mooted, that will have a minor effect. Or the FT reported last week, they're actually considering literally giving some money directly to energy companies when the gas or electricity price goes above a certain level, and then those companies have to repay the money if it drops back below. So kind of doing a bit of a balancing act to try and kind of keep the bills in check. So there's lots of stuff with lots of unknowns going on. One thing we do know is that gas prices are down a bit from their peak in autumn. You can see that on this chart. Now, we've got to be slightly careful because this is kind of the global index. You know, gas is a very kind of almost localized market. So the UK gas prices that we have to pay might be different from this. But it's certainly off from the peak that we saw in autumn. But we don't know which way this is going to go, because the one thing that will drive the gas price more than anything else, I think, is what's happening with Russia. We've, of course, got lots of Russian troops on the Ukrainian border, and most of the gas that comes into Europe comes from Russia via Ukraine. So anybody who tries to predict that, I think, will find it very difficult to do. And of course, gas is the big driver at the moment. It's a driver of electricity prices, because these days we burn a lot of gas. We don't want to burn too much coal because it's really bad for the environment. Obviously, ideally for electricity, we'd use renewables, but when the wind isn't blowing, we need a backup, and that tends to be gas. So looking at those two factors, transport, I think definitely falls into the temporary inflation camp. Energy prices, it's really hard to say. They're definitely going to go up a bit more, but how much depends on lots of different factors. But as I said, inflation is, we always look at prices from one year to the next. So this is how we normally look at inflation. And this looks at how inflation has changed over the past decade. It is worth remembering, even though inflation right now is very high at 5.4%, most of the last decade, we've actually seen quite low levels of inflation. The red line on there is the Bank of England's target of 2% per annum. And for a lot of the last decade, we've actually seen inflation below that. And as I've said before, looking at year-on-year changes can sometimes distort things. Why not instead look at rolling 5-year levels of inflation? If we look at that, it gives us a better idea of long-term trends. And over the past decade, for a lot of the time, inflation has been running at 1.5% per annum. It's certainly been below 2% for a long time. We're now still, even right with high levels of inflation right now, still only seeing 2.4% inflation over the last 5 years. And I think there are lots of reasons to think inflation will come down over the next 12 months or so. The Bank of England thinks it may peak in around April. A lot of people think it may have already peaked in the US. The main reason it's likely to come down is because of the base effects. Right now, inflation is being pushed higher because it's comparing to low prices from last year, a low base. However, if we look at, what inflation is likely to be like in 12 months' time, we'll be looking back at what prices are like now when they're a lot higher. And we're starting to see some of the things that are driving inflation start to moderate. So we talked a lot about supply chains. And one way we can look at what might be affecting things is look at shipping costs. So shipping costs have gone up a lot over the last year, but they've just started to come off their peak. They've started to come off from where they were in the autumn. So that's a positive. We can also ask businesses what they're seeing. And one of the ways that's a good way of looking at what inflation might be in the future is to ask manufacturers not what prices they are having to charge us when they sell the goods to us, but what prices are they having to pay for the component parts. And that's the blue line on here. This is looking at US manufacturers. It goes back 15 odd years. Historically, it's been a good indicator of which way inflation is going to go. So the blue line is US manufacturing prices paid index. The orange line is US inflation. Now, they're not perfect fit by any means, but it tends to go in a similar direction. The blue line tends to be a good lead indicator. And we can see that blue line has come off its peak. It's come down. So we would expect the US inflation figures to follow it down as well. So lots of unknowns with inflation, lots of things that I think are temporary factors, some things that may not be. But one thing we do know is that central banks are targeted to keep inflation under control. And because inflation is currently above those targets, they're going to do something about it. They're going to put up interest rates. The Bank of England already did in December. The US is probably likely to follow, maybe in March. Currently, the market is pricing in a 76% probability that the Fed in the US will put up interest rates 4 times in 2022. Normally, they put up interest rates in 0.25% increments. So that will be a total of 1% increase. They may even do more. At the same time, they'll be dialing back quantitative easing, so removing stimulus from the market. So we think US rates are going to go up. Here in the UK, one thing we like to look at is something called the sterling 12-month overnight swap rate, which is the blue line on this chart. Essentially what that is what investors think interest rates are likely to be like in 12 months' time. The orange line on there is the Bank of England base rate. And you can see the two lines tend to follow each other. The blue line tends to anticipate where the orange line is going to go. So if this indicator's right, then UK rates perhaps might be 0.75% by the end of the year, maybe even 1%. So I think we definitely should expect interest rates to go up, provided the economies keep recovering and we don't get any horrible new variants coming along. And when interest rates go up, that has some interesting effects on various different asset classes. In particular, it has a direct impact on government bonds. And this chart shows the yield of the UK 10-year gilt, which is the orange line, and the blue line shows the US 10-year bond. And it shows what the yield has done and how it's changed over the last 6 months. And you can see the orange line, gilts, has gone from around a 0.6% yield to around 1.2%. So it's doubled in 6 months. In the US, yields have gone from 1.2% to 1.8%. So again, have gone up quite a long way. Now, that's because when interest rates go up, that makes cash look more attractive. So if you're going to tie your money up for 10 years and lend it to the government for that length of time, you want to get a higher level of interest to make it more attractive compared to cash. So yields have got to go up. Yields always go up when interest rates go up. But because bonds actually pay a fixed level of interest, that's why we call them fixed interest, The only way a yield can go up is if the price goes down. So whilst we always talk about bonds in terms of yield, what we mean when the yields go up is basically means prices have fallen. So the last 12 months, 2021 as a whole, was a pretty poor year to be invested in bonds. Gilts, which is the green line on the chart, lost you 5% in the last year. Corporate bonds lost you 2%. Our fixed interest funds is the blue line. And that at least kept its sort of head above water. It didn't lose you money, but it didn't make you a great deal of money either. So fixed interest has been a definite drag on returns in the last 12 months. We have a lot less fixed interest than a lot of people. A lot of people will hedge their equity exposure purely by having government bonds, and they will have found their fixed interest holdings a lot more painful than we have. But nevertheless, bond exposure, one of the main ways that we can hedge equity exposure or diversify equity exposure, has been a drag on returns. But that doesn't usually matter when you have a good year in stocks. And last year was a good year for stock markets. But even here, though, it really did depend which stock market you looked at. The US market had a fantastic year. It was up 29% over the whole year, 2021 as a whole. The UK did okay. It gained 18%. That's a good year in a normal year, a long way behind the US, but not too bad, as it recovered from a very poor year the year before. European stocks did all right as well, 16% up. But outside of those regions, you would have actually found returns pretty hard to come by in the stock market. Japanese stocks hardly made you any money at all. And emerging market stocks actually lost you money last year. And if you put all your money in China, you'd be sitting on a pretty hefty 21% loss last year. So this is quite unusual. So you see such a diverse range of kind of different returns. Depending where you put your money, you could have had a 29% gain or a 21% loss. Now, of course, at all times, we try and be nicely diversified. So we'll tend to have money in all of those regions. So our returns from our equities are somewhere in the middle. So returns have been pretty concentrated from an equity point of view in the US. But they've just not just been concentrated in the US market as a whole. They've actually been concentrated in a very small number of stocks. These are the top 5 stocks within the S&P 500, the main US stock market. Apple, Microsoft, Amazon, Tesla, and Alphabet, which is Google. Now, Alphabet has 2 share classes, which I've added together, which is why the larger number appears at the bottom of the table. So those are the top 5 companies in the US. Give or take, add those companies together rather, and that's about a quarter of the index is in those 5 companies alone. Certainly, if you add in things like Facebook and Nvidia, which are some other tech stocks near the top of the index, it's well more than a quarter. So, as I said, they are all tech stocks. And we like tech stocks. Tech stocks are great. They tend to provide some really good long-term growth, but they can also be volatile. Whenever anyone mentions tech stocks to me, one of my first things I always go back to in my mind is what happened in 1999-2000, when we had a big bubble in tech stocks, which then burst. And I'm certainly not trying to say that that is going to happen again, by the way. And when we talk about tech, we often talk about the NASDAQ index. This is the top 5 holdings in the NASDAQ index. It's the same companies. It's a bit more concentrated. The NASDAQ has 11% in Apple, nearly 10% in Microsoft. But the S&P has got nearly 7% in Apple and nearly 6% in Microsoft, so it's pretty concentrated too. Over time, the US stock market, the main market, has become more and more like the NASDAQ. And we can see that when we look at returns from last year. NASDAQ and the S&P 500 returned pretty much exactly the same thing, same return. NASDAQ's a little bit more volatile because it's a bit more concentrated, but they are very, very similar right now. And I shared some analysis in our December newsletter, and I thought it was absolutely remarkable. This is only up to the 6th of December. But if we look at the NASDAQ index as a whole, so the blue line is the NASDAQ, in 2021 up to that point, the NASDAQ was up about 20%. If you took out the top 5 stocks, your return wouldn't have been the blue line at all. It would have been the kind of gold, yellow line. You wouldn't have gained 20%, you would have lost 20%. So the returns in the US market have been very, very concentrated, not just within, one different sector, but actually in a very, very small number of stocks. Take those out of the market and you wouldn't have had a great return at all. And this kind of level of concentration is quite concerning. This is a global equity index that a lot of fund managers use as kind of a benchmark. The MSCI World Index has now got 69% of its money in the US. Actually, more than a quarter of that is in IT. And you can see those same big American tech stocks take up most of the top 10. So, as I said, this level of concentration is quite concerning. You would never, ever convince me that it would be a good idea to put 69% of your money in one region. And you would never convince me that we should be putting 25% of your money in one sector like IT. We want to be much more diversified than that. What happens if those 5 stocks underperform over the next 12 months? They've very much benefited from the working from home dynamic. What happens if the economies continue to recover? So I think you need to be very careful about putting too much money in these indices, in these stocks, because the one thing we do know, apart from anything else, with tech stocks is that they don't tend to do very well when interest rates go up. And that's what we're seeing in the past couple of weeks with the big tech, but it's been going on for quite a while under the surface. This is from the FT, and it looks at the US real bond yield, so basically the bond yield minus inflation, which is the blue line. And then the pink line is something called the Goldman Sachs Non-Profitable Tech Index. So it's looking at the technology stocks outside of the big boys, those that are slightly more speculative, that you're betting on long-term growth. Since about November, when bond yields started to go up, those have come off a long, long way. So tech stocks have been underperforming for a while. It's just only recently we're starting to see that in those kind of the big boys in the US. But the good news is not all stocks do badly when bond yields or interest rates go up. This is from JP Morgan, and it's looking at the correlation of various different types of equity to the US 10-year bond. So at the bottom, what we've got is large cap and growth stocks, like those big tech stocks, which are negatively correlated to bond yields. So basically what that means is when bond yields go up, they tend to go down. That's what we're seeing at the moment. But there are lots of other things that are positively correlated. So in particular, small cap stocks and what we call value stocks, which tend to be more cyclical stocks linked to the economy, those that might have actually been hit hardest by the pandemic. They tend to do well in a rising interest rate environment. So does Japan, Europe, and to a lesser extent, the UK. And so that's what we've seen a little bit so far in 2022. Now, I put this chart in last week, so it's not quite up to date. And we've actually got quite a few queries in the last couple of weeks seeing that the FTSE has done really well. At this point, it was up over 5% over a month. But the balanced portfolio was basically flat. So people have been asking, well, why isn't the balanced portfolio doing better? Why isn't it giving us some gains when the FTSE is doing so well? And the answer to that actually is because pretty much everything else, other regions of the market, bonds, equities have been falling. So over that period, you see, the S&P 500 was down 5%, gilts were down nearly 5%. So the FTSE 100 was a bit of an anomaly. That's because it is full of some of those value stocks that tend to do well. And it's full of energy stocks, which are doing well at the moment. We have seen a bit more volatility recently. We fell down quite sharply to about 7.3. As of this morning, we're back to about 7.5. And I think you should be careful comparing our performance to the FTSE 100, because obviously a balanced portfolio doesn't just invest in equities. It has less than half in equities. Of those equities, less than half is in the UK. And of those UK stocks, we tend to put not very much money in the FTSE 100 at all. We tend to invest much more money in the FTSE 250, which is the next biggest 250 stocks outside of the top 100, or even in small caps. And if we look over the last 12 months, we see something quite unusual. For the first time in a long time, you've seen the FTSE 100 do better than the FTSE 250. So the blue line on there is the FTSE 100. The turquoise line is the FTSE 250. Our UK equity funds tend to follow a bit more what the 250 does, and that's the pink line on the chart. And interestingly, you can see the 250 was actually well ahead of the 100 as of September, and since then it's actually gone down slightly, whereas the FTSE 100 has come moved ahead. So, you know, it's been a difficult time to be invested recently because at the headline level, we're seeing some good returns, but it's been very concentrated in one or two areas. So things like US, those big tech stocks, and in large caps rather than small caps. And we historically wanted to be more diversified than that. And in particular, we like to have lots of small cap stocks. But if we come back to the chart I just showed you before, you know, where do we want to be if interest rates are going up? We don't want large cap and growth stocks. We want more small and value. So, you know, that's where we are a little bit more allocated. We've got investments in all the different types of equities because, you know, we don't want to bet the house on any one outcome, but we've been tilting more towards value and more towards small caps. And this shows you why we like small caps. Over the long term, they tend to outperform. So, you know, this is just looking at the UK, but over the last 5 years, you can see the big boys, the top 100, have done about 25%. Your medium-sized stocks, the FTSE 250, has done 40%, but your small cap stocks are up 53% over that period. And our portfolio, our selection of UK equity funds has done pretty well. But one area where we do have more exposure to the FTSE 100 is within our defined returns products. And over the next couple of months, we've got 4 products that might kick out. And if they do, that will be positive for returns. They amount to about 6% of a cautious or balanced portfolio. So on Monday, we've got a Credit Suisse product, which will kick out if the FTSE is above 7,588. As of this morning, we were at 7,500. Last week, we were at 7,600, so it was looking good. But then we've been down well below that as well. So who knows whether that's going to kick out or not. On that same day, we have another product that may kick out if the market is above 7,286. So that's looking pretty good, fingers crossed. Then towards the end of February, we've got another one from BNP Paribas, which will kick out if the FTSE is above 7,000 or so. And then in early March, we've got one with Morgan Stanley, which would kick out if the market was above 7,196. So the bottom 3 would kick out based on current market levels. Credit Suisse wouldn't if we stayed where we are. Now, as with all defined returns, they give you a fixed rate of return that's defined in advance. That's how we give them the name. And the rate of return has ranged, for these products, ranges from 10.83 up to 14.95% per annum. Now, you get that rate of return multiplied by the number of years the product has been held. If they kick out this year, they will have been held for between 2 and 4 years, depending on the product. So that ranges from returns for the total life of the product from 22% up to 43%. Now, remember, because these products are priced daily, that a lot of those gains are already in the price. But if they do kick out, we'll get a nice little boost. So let's focus on one of those products as an example. We'll focus on Credit Suisse. And this was set up on the 30th of January, 2018. And on that day, the FTSE 100 was at 7588 and the S&P 500 was at 2822. It promised to pay us a rate of return of 10.83% per annum, and it would pay that on any one of the first anniversaries where the markets were above those starting levels. Now, for the first 3 anniversary days, the market has been below the starting levels, or at least the FTSE has. The S&P is actually well above there. If it kicks out next week, that will be year 4. So that would give us a return of 4 times 10.83, which is 43.32%. If it doesn't kick out, though, all is not lost. It just simply rolls on to the next year, year 5, in which case we might get 5 lots of 10.83. Or if not, it then could roll on to year 6. And at that point, the return is near enough 65%. If we still get to the end of year 6 and the market's still down, has never kicked out, we've never been above the starting levels, then we just get our original money back. So over the life of the product, the return would be 0. So that's still a pretty attractive product, even though things have been volatile, even though the market's been down below those levels for most of the last few years, it still looks like it could provide a pretty good return. This is what's happened to the 2 markets that product is based on since the product was launched. This is just up to the end of December. And obviously over that period, the grey line, the FTSE, is still down, as we have just seen. But the S&P 500 is miles ahead of where it was at the start. This is quite unusual, because normally the 2 indices are really correlated. That's why we like to use them together in a structured product, a defined return product. But since the pandemic, you can see that such massive divergence with the US, the technology companies really helping to power returns in the S&P 500 compared to the FTSE. And this is one of the things we've seen in the portfolios at the moment. One of the reasons we don't have that much US exposure in our equities is because we've got it in defined returns. But because the S&P 500 is so much in the money now, then when the S&P goes up more, it doesn't really make a difference to the defined returns. It's all down to what the FTSE does at the moment. But had we decided not to buy defined returns, we might have bought those indices directly, then we'd have got dividends instead. So that last chart I showed you only showed the price return. This chart shows you the total return if you'd have reinvested the dividends. So if we'd have bought a FTSE tracker, we'd have got a 13.5% return over that period, and we'd have got a 77% return from the S&P 500. If we'd have decided not to buy defined returns, but instead put 50% in each of these indices, interestingly, the average return would have been 45%, which is almost exactly the return we're expecting to get from Credit Suisse if it kicks out. So these are successful products. You know, we've not actually given up any upside for that fixed return compared to just investing in equities as a whole. But what we have had is some of this capital protection element thrown in. So hopefully they will kick out, and hopefully that will help. If they do kick out, then what are we going to do with the money? Because we will have a load of more cash in the portfolios. Well, we're going to reinvest a smaller proportion of it, we think, into defined returns. We might choose a slightly more defensive type of defined returns, essentially one that would kick out if the market fell a little bit. Because we still think the market is a little bit expensive, could be volatile. So having something that provides a positive return, even if the market goes down a bit, would be quite nice. Longer term, we still think the market looks okay, but we still think there's volatility. So perhaps a more defensive type of defined return might be positive. The other thing we might do, and this may seem a bit strange, given what I've said about US and tech, is we might buy some more US index tracking fund directly. Don't forget, if these defined returns kick out, we'll have even less US exposure than we've got now. And coming back to what I said before, I don't want to bet on any one outcome and say, you know, I want to be completely out of US because I'm a bit worried about it. We still want to have some exposure. I still think Microsoft and Apple and Amazon and all those are good companies, even if they might be volatile short term. So we might actually put some money from defined returns back into the US, into an index tracker, but we have another product, another fund that we use that we think will act as a hedge. So we would buy a bit of our US tracker and a bit of this hedging product at the same time. So in a way, it's a bit like a defined returns, exposure to the market, but with a bit of downside protection. And then the other thing we plan to do is top up some more of what we call real assets. So real assets is a term we're starting to use more and more at the moment. And what we mean by real assets is we mean things like property, and we mean things like infrastructure, and we also got some forestry now in the portfolio. Now, what these asset classes have in common is they are all based on a physical asset, whether that's a building, or in the case of infrastructure, it might be a toll road or a wind farm or something like that. Now, what they all have in common is that they tend to provide a nice solid level of income, like a rent or like some, the money from selling the power. And crucially, that income tends to go up with inflation. And the capital values of the underlying assets tends to go up with or even above inflation. So come back to right full circle to what I said at the beginning. We want to, with inflation being higher, we want to make sure we've hedged our risk and got some inflation-linked assets in the portfolio. So rather than just diversifying our equities with bonds, so you can see gilts on there, which I said earlier have gone down over the last year, we're diversifying them more with property and infrastructure. So gilts have lost 5%, properties gained 4%, infrastructure's gained 5%. So not shut the lights out by any means, and they can be more volatile and they can be more equity correlated. But in a rising inflation environment, real assets is something we want to have in the portfolio. So this is the term we're now starting to use to kind of group these asset classes together, because you can see they tend to do something similar. So when you next get your valuations, your pie charts might look a little bit different. They'll look something like this. This is the balanced portfolio now. You've got now this new color, this purple color, 12% in this real assets category. So that's property, that replaces property. We've got around 4.5%, and it includes forestry and infrastructure. And previously, infrastructure was in the orange part of the pie chart, which is alternatives. So right now, as I say, there are lots of uncertainties out there. We think the economies are going to carry on recovering this year, and we're pretty sure interest rates are going to go up. But we also know that you could get another variant come out the woodwork and derail all that. So we need to be well diversified. So we want real assets to protect against inflation. We want some decent equity exposure. We want a mix of different outcomes, different types of equity rather, but we'll be slightly more biased towards small cap and value and less large cap and tech. We've still got quite a lot of fixed interest, but within our bonds, we've got more things like floating rate bonds, which tend to do better if interest rates go up, or higher yielding bonds, which don't tend to be as sensitive. So we want to be really nicely diversified at the moment. So what have returns been like? Well, I hinted earlier that returns over the last quarter have been, shall we say, average at best. They've not been brilliant. They've been a bit sluggish, to be honest. No matter which portfolio you were in of our core portfolios, you'd have got somewhere in the region of 1% return over that quarter. Interestingly, that's the first time for a long time that Adventurous has been the worst performing of the three portfolios, tends to outperform over the long term. And the reason why we're seeing a slight bit of underperformance recently is because it does have more of those more speculative high growth tech companies that have been selling off for quite a while. We think they'll do really well long term, short term they're volatile. It does have more emerging markets like China, which I think, again, we expect some good long term growth. In the short term, it can be volatile. So Adventurous has slightly struggled recently, and the same could be said for global equity. Your typical global fund, as I said earlier, tends to be very much US based. Ours is much more diversified. If we look at the defensive fund, which is meant to outperform cash, well, it's done that over the past 3 months. It's not quite done it by 3% annualized, which is our long-term target, but that's okay. And it's done reasonably well since launch as well. I haven't got 1-year figures to show you because it was only launched in February. But for the other portfolios, if we look over the last 1 year, we actually see returns pretty much in line with long-term expectations. You know, Cautious has done 6.5% over the last 12 months. Balanced has done 7.7%, and Adventurous 9.5%. The average mixed investment fund that has between 20 and 60% in the stock market did 7.6%. So as I said, these returns are pretty much in line with what we would expect to see. Cautious will tend to underperform slightly in a rising market, but Balanced and Adventurous have outperformed. Balanced has outperformed that sector 4 years in a row. Adventurous will tend to outperform in a rising market, underperform in a falling market. Over the last year, global equity is slightly below the global sector. So as I said, it doesn't have as much US, but it has outperformed since it was launched. If we look over 5 years, you see pretty decent returns. Cautious has done 30%, Balanced 35%, and Adventurous 46% per annum, 46% total return over that period. If you look on an annualized basis, that works out as 5.4% for Cautious, just over 6% for Balanced, and nearly 7.9% for Adventurous. And come back to what I mentioned at the beginning, it's all about inflation. Our target is to try and provide you some decent returns well above inflation. And that's still what we've managed to see over the last 5 years, despite inflation going up. That's a real return for Cautious of over 3% per annum over that period. Balanced close to 4%, and Adventurous 5.5% per annum real returns. So looking forward, you know, I wouldn't be surprised if some of this volatility does continue for a little while. We're not expecting an out-and-out stock market crash, but certainly I think things could go down a little bit before they go back up. Certainly, I think we want to be slightly wary about some of those big tech stocks. Longer term, though, we're still positive. I still think equities can give you some really good returns over the next few years, and we should be able to achieve those real return targets that we want to see. So thank you very much for listening to me today. I hope you found some of that useful. I'm going to stop sharing my screen now, and hopefully I'll now be joined by my colleague, Ben Rogers, and he's going to help me to go through some of your questions. Hi, Ben.
Hi, Mike. Thank you very much for today's presentation. One of the first questions that came through was actually from Anne, and it comes back to those sort of changes to the reclassification of some of those asset classes, siphoning off infrastructure and property to a new category of real assets. Anne asks, what is left in the alternative equity part asset class once we take away those real assets?
Yeah, that's a really good question, actually. So alternative equity, really, and we're actually dropping the word or equity out of it. We're just calling it alternatives from now on. It actually is basically any asset class that doesn't really fit into any of the broad categories, whether it's fixed interest, equity, or real assets, for example. So it might include absolute return funds. It does include absolute return funds, where those funds can go both not just long the market and make money from stocks going up, but can also make money from stocks falling. So they can be short stocks. So it's got some of those in it. It has some ones that do a similar thing to that on bonds. So it's almost an absolute return bond strategy. So those are the sorts of things we tend to have in it. Absolute return type strategies, trying to give us some diversification. In a period where we're not that keen on bonds, can we find something else that's a bit bond-like that will give us slow and solid returns if equities are struggling? And it also includes, now I mentioned earlier, we have a product in our portfolios, which is essentially a hedge against equities falling. It's a fund that will go up well. It's called the Dynamic Volatility Fund. It's a fund that we think will go up if volatility goes up. So basically, when markets go down, you tend to get high levels of volatility. So it tends to work well. So within that alternative equity category, there's, as well as absolute return, there is our, what we would describe as our equity hedge product as well.
Brilliant. Thanks, Mike. The next question came from Peter. Now, obviously, you mentioned earlier on that nobody can predict what's going to happen with Russia and NATO and the border of Ukraine. However, Peter would like to ask, what strategies are there that could protect investments in the event that things escalate further and we end up seeing war in Ukraine?
Yeah, it's a really interesting question, because it is a very difficult one. I think, you know, I mentioned earlier as well that we're not trying to, we never want to bet on any one outcome. And we've always got in the back of the minds, you know, what if there was another variant of COVID or something else that would have an impact to the economy? And that's why we're never going to sell completely out of bonds, for example, or, you know, all those sorts of things, because those are the sorts of assets that tend to do well if equities fall out of bed. And I think the same would apply if we ended up, you know, in some sort of conflict with Russia. You know, those sorts of assets that tend to do well. I mentioned the hedging product, some of our bonds that we think would do well if equities fell, and certain types of equities actually. You know, I'm be interested to see, you know, I think some of actually the energy companies might do quite well in that scenario, because you know, if we can't get, you know, Russian gas for some reason, then, you know, that, you know, an alternative source is positive. So, you know, in all of these things, there are always going to be asset classes that will do better and some that will do worse. I think generally most equity markets would fall in that scenario. I don't think there's any getting around that, but we have got some assets in the portfolio, like bonds, like our hedging product, which would do well if equities fell.
Thanks, Mike. The next question has come from an anonymous attendee. How do you invest in real assets? Are these through specific funds, and are they UK based?
The property funds are largely UK based, nearly all UK based, and we invest in that in a mixture of direct property funds, which basically just hold the assets, and their OICO unit trust funds, and those funds just reflect the return of the asset class. And we also use real estate investment trusts. So they just own the buildings, but they are listed on the stock market. So they're essentially a property investment company. So they can be a bit more volatile. So they can be a bit more correlated to equities because they're listed, but underlying assets are property. So they're mainly UK. We like assets like distribution warehouses. That's what you need when everyone's moving to online shopping. We like healthcare assets, things like care homes and GP surgeries that tend to give you a very solid level of income and tend to do that no matter what the economic outlook is. When we look at infrastructure, that's a bit more global. So there is some UK exposure in there, but there's some more global. So there is, you know, lots of renewable energy, sort of wind farms and solar panels all around the world. We've got US, we've got Asia, and we've got UK and Europe. So a big diversification there. And we also have a small amount in forestry as well, which is forestry is all UK.
Brilliant, thanks, Mike. Roger has asked, hi Mike, what are your views on the pound against the dollar and the euro?
Yeah, it's a difficult question. I never like to try and predict currencies, as you know. I think it's one of the hardest things to predict, especially against the euro. You know, that's a hard one to predict. Against the dollar, you know, if interest rates go up quicker in the US than they do in the UK, then generally that would normally mean the dollar would go up a little bit. On the other hand, though, the dollar tends to be where people move their money into if they're worried about something. So, you know, coming back to, you know, if we've got conflict with Russia, you'll probably see the dollar go up. So it's really uncertain, to be frank, you know, and against the euro, it's even more uncertain. I wouldn't be able to give a view. I'm not an expert in currencies. You know, where they are now is actually, you know, reflecting all the views and all those things that we've said might happen to the economy. So I'm afraid I'll put that in the I don't know camp, I'm afraid.
Okay, thanks, Mike. Sorry, just had a little flurry of questions come in. In terms of the defined returns products, you've obviously asked a question of, are they a good bet when markets are volatile, given that they depend on a spot price? You mentioned obviously that if these products kick out, some of that the proceeds may be reinvested in part into a defined returns product, albeit a defensive one. Are you happy to chat through the nature of that that particular fund?
Absolutely. So, you know, defined returns, if we are going to an investment bank and asking them to set up a new defined return, the rate of return we will get will depend on lots of different factors. But the main ones are how volatile the equity market is. Because in essence, what the investment bank is doing in the background is selling a package of derivatives to people that are more, that people can use to hedge their risk. And they're more attractive when markets are more volatile. People are more worried. So a few weeks ago, when we were looking at the defined returns and planning what we might do if they kick out, we were probably saying, actually, we don't want any more defined returns because markets were really calm. Obviously, the markets are at higher levels. So the higher the level, the less attractive starting point. But markets were so calm, the rates that we were getting offered from the banks were really low. So if we wanted to do just an S&P 500 defined return, we'd get a 6% per annum. So the ones I showed you earlier were kind of ranging from 10.8 to nearly 15%. If we wanted to do just the FTSE one, it was maybe 8%, which is okay, but it's not too bad. As markets have now become more volatile, the rates that we might be offered are going up a bit. And because they've come down a bit, or certainly the S&P's come down a bit, the starting level is slightly more attractive. So we can't finalize the plan in summary until we actually get the kick out, because at that point we'll know what rates we're being offered from other providers, what starting levels we're at. So at the moment we're minded to put a bit of money back into defined returns. We can get, we think, about an 8% return from a defensive plan now that's linked to both the FTSE and the S&P. So a defensive plan, essentially, if the market goes down 5% over the next 2 years, I think, then we might get a kick out. Whereas, you know, normal plans will only give you the kick out if the market goes up or stays the same. Okay. So yeah, certainly looking more attractive. I'm not sure we're quite there in terms of them looking really attractive at the moment, but they're certainly looking more attractive. So, you know, we'll report on what we actually do next week, if and when we get those kickouts. Okay,
brilliant. Thanks, Mike. In terms of time, that's we're coming up to time. There are a couple of questions from clients. However, they're quite specific to their own portfolio. So for those clients, we will be in touch later on today to chat you through those questions. They're a bit more specific. But on behalf of everyone, I'd like to say thank you very much, Mike, and it's been really interesting.
Great. Thanks very much. Thanks, Ben. And thanks everyone at home for listening to us today. Hopefully you found it useful, and we'll see you again next time. Thanks a lot.